Most people today believe that the next major financial crisis will come from stocks, housing, or government debt. But what if the real danger isn't coming from any of these visible markets at all? What if the real threat is sitting in a shadow system most people never see, never hear about, and never think to monitor? A system that has quietly grown into a multi-trillion-dollar giant with almost no regulation, almost no transparency, and almost no oversight. A system that Wall Street elite claim is safe yet behind closed doors. They are issuing urgent warnings because over the last several weeks, something disturbing has happened. New data, internal reports, and leaked memos have revealed that the private credit meltdown once described as contained has just gotten much worse. What was once celebrated as the future of modern finance has become a growing risk that threatens not only investors, but the global financial system itself. But how did we get here? And why is this meltdown accelerating right now? To understand today's crisis, we have to go back to the beginning. Private credit didn't appear out of nowhere. It was born after the 2008 financial crisis, when banks punished by regulators and pressured by governments were forced to tighten lending standards. New policies made it harder for banks to lend and harder for companies to borrow. This created a massive gap, a void in the credit market big enough to swallow entire industries. And into that void stepped a new group of financial giants firms like Blackstone, Apollo, KKR, Ares, and eventually Blackstone. Instead of deposits like banks, they used investor money to provide direct loans to companies. They didn't need to go through regulators, didn't need to follow strict capital rules, and didn't have to disclose risky loans to the public. This was the start of the modern private credit industry, a shadow banking system that operated outside the traditional structure. At first, private credit looked like a brilliant innovation. Investors were desperate for yield, and private loans offered exactly that. High returns with the promise of low risk. The pitch was simple: lend directly to stable companies, charge higher interests, and collect steady profits. But the lack of oversight created a hidden weakness. Private credit funds could value their loans however they wanted. They could downplay risks, delay recognizing losses, and quietly restructure failing companies without ever revealing the truth. As the industry grew, so did the illusion of stability. For more than a decade, private credit expanded at breakneck speed. What had once been a $300 billion niche ballooned into a $1.7 trillion powerhouse. By 2023, it had surpassed the size of the entire U.S. high-yield bond market. Investors poured in billions. Pension funds, endowments, insurers all convinced that private credit was safer, smarter, and more stable than public markets. But behind the scenes, the lending standards were eroding. As more funds entered the market, competition for deals intensified. Asset managers began offering covenant-light loans with almost no borrower protections. Companies that were too risky for banks suddenly had access to enormous loans. Private equity firms used private credit as fuel, loading companies with debt to finance buyouts and acquisitions. The system became increasingly fragile, dependent on one thing: low interest rates. That era ended abruptly in 2022, when the Federal Reserve launched one of the most aggressive rate hikes in modern history. Private credit was hit with a shock it had never faced before. Most private loans were tied to floating interest rates, meaning borrowers' costs soared every time the Fed raised rates. Loans that once cost companies 6% now cost them 10%, 12%, even 15%. Debt burdens became unbearable. Many borrowers were suddenly paying more in interest than they earned in profit. For companies already operating on thin margins, this was fatal. Defaults began to rise. Borrowers missed payments, and private credit funds quietly started downgrading their own loans internally, not publicly. But the most alarming part was the valuations. Public markets were showing clear signs of stress bond defaults rising, credit spreads widening, corporate bankruptcies increasing, yet private credit portfolios reported almost no losses at all. Mathematically, this was impossible. The only explanation was that losses were being hidden or delayed through opaque valuation methods. This created a dangerous scenario. Investors believed their portfolios were stable, even as the underlying loans were deteriorating. Over the past few months, the situation has deteriorated much faster than expected. New data shows that private credit default rates have surged to their highest levels since the 2008 crisis. Quarterly downgrades have hit new records, doubling from last year. Recovery rates, the amount lenders recoup after default, have collapsed, in some cases falling below 40%, the lowest on record. Borrowers are running out of cash, unable to refinance their debt, at today's interest rates. Several major lenders have frozen withdrawals, signaling severe liquidity pressure, and many companies that are dependent on private credit financing manufacturing firms. Retail chains, tech startups, healthcare operators, real estate developers are now showing signs of financial distress. The spillover effects are enormous. Private credit funds don't just lend, they partner with banks who provide leverage. When private loans sour, banks lose too. This creates a chain reaction. Losses at private credit funds lead to margin calls at banks, which trigger forced selling, which tightens liquidity across the system. Suddenly, a crisis that was contained becomes widespread. The private credit meltdown is no longer a theoretical risk. It is happening right now, and its ripple effects are beginning to spread. Efforts to slow the crises haven't worked. Funds have tried extending loan maturities, injecting new capital, merging portfolios, and restructuring troubled borrowers. But these efforts only delay the inevitable. The core issue isn't liquidity solvency. Many companies simply cannot survive under current interest costs. The math no longer works. As long as rates remain elevated, defaults will continue to rise, valuations will continue to fall, and more funds will face redemption pressures. What makes this situation even more troubling is that it mirrors previous crises. In 2001, risky tech lending collapsed. In 2008, mortgage-backed securities imploded. In 2020, corporate debt nearly caused a credit freeze. Each crisis shared the same 5 ingredients: rapid growth, easy money, lack of oversight, hidden risks, and delayed recognition of losses. The private credit market has all these features on a much larger scale. The pattern is repeating, and history shows that once the cracks begin to form, they eventually widen. The signs are now impossible to ignore. The private credit meltdown is accelerating. Losses are rising, borrowers are failing, redemptions are being halted, and stress is spreading throughout the financial system. Investors, regulators, and analysts are finally beginning to acknowledge the magnitude of the problem. What was once treated as a niche market is now large enough to destabilize entire sectors of the economy. The first key takeaway is that the private credit meltdown is not a distant threat. It is already here, and it is intensifying with every month that interest rates remain elevated. The second takeaway is that most of the public has no idea how severe the situation has become because private credit operates largely in the shadows. And the third takeaway is that the fallout will not stay contained. It will affect companies, lenders, banks, workers, and global markets. The final warning is simple. This system was built for a world of low interest rates. That world is gone. The shockwaves from this transition are not temporary, they are structural, and they will reshape global finance for years to come. If you want to stay ahead of this story, not after it happens, but before, make sure you're subscribed. Turn on notifications and share this video with someone who needs to understand what's happening beneath the surface. The private credit meltdown has just gotten worse, and in the coming weeks, new revelations may change everything we think we know about the financial system.